What if your dream vacation spot could become your next retirement investment? That's exactly what happened for one high school teacher named Susan, who used her self-directed IRA to purchase a beachfront rental property in Florida. She didn't just grow her retirement savings, she actually created a place where families could make memories. And in this episode of Getting Real, we're going to break down how Susan turned her beach dream into an income-producing IRA investment and what real estate investors need to know before they do the same. Now, don't forget to subscribe to our YouTube channel here and hit the bell icon so we can alert you to all of our upcoming content. Susan spent over 10 years vacationing with her kids on beaches near Jacksonville, Florida. She always dreamed of owning a house there, but didn't have enough cash on hand. Most of her money was in her IRA or tied up in conventional retirement accounts. That changed when she met a commercial real estate broker who suggested she roll her IRA into a self-directed account and buy a property with those funds. The one conversation that she had here sparked everything. Susan researched online and she found a company called Equity Trust. So she opened a traditional IRA and she transferred her funds from her previous IRA to the new self-directed account. No taxes or penalties, of course. She then hired a local real estate agent who helped her purchase a $308,500 beachfront rental property in Jacksonville, Florida. She also hired a property manager and contractor to complete all the renovations and a property manager to handle the ongoing maintenance of that property. So 2 years after she first had this idea, this beachfront rental property welcomed its first vacation guest, and it started generating about $40,000 per year in rental income. And because the property is owned entirely in her IRA, all of the income goes directly back into her retirement account and it grows tax deferred. So there's some unique tax advantages there. Now, Susan expects to fully recoup her investment in under 10 years and potentially use the income to acquire another property down the road. Now, if you're interested in investing in real estate just like Susan, let's talk about the 4 things that you should be aware of. So number 1, no personal use of any kind. So even though Susan dreamed of living in a beach house one day, she knew that there were specific rules that she needed to follow. So the first rule that you should be aware of is no staying in the house. So not even for one night can Susan stay in that property. The next is no letting your children or parents stay in the property. So there are disqualified persons with respect to the IRA, and those disqualified persons cannot use that property for personal benefit. So no personal benefit of any kind. The property must be held exclusively as an investment. That's the best way to think about it. So it's generating income, and that income is flowing back into the self-directed IRA, and then all expenses are paid out of the self-directed IRA. The next, number 2, is no sweat equity. So this is an important rule. This means no swinging the hammer to the nail. If your IRA owns a property, you can't paint the walls, do the landscaping, again, do the physical work on the property. And that's because it could be considered providing a service under Internal Revenue Code 4975. That could be considered a prohibited transaction. In this case, Susan followed this to the letter of the law. She hired a licensed contractor to handle all the repairs and renovations, and she paid them directly from her IRA account. Number 3, all income and expenses must stay inside the IRA. This is one of the most important mechanics of using a self-directed IRA for real estate. Every dollar that is related to the property, whether it's rent coming in or a repair bill going out, it must flow through the IRA. So that means rent checks are made out to the IRA, not to you personally. Property management and contractor fees are paid from the IRA. You don't pay out of pocket and you don't deposit income in your personal bank account. Again, everything flows in and out of the IRA. Number 4, watch for disqualified persons. So the Internal Revenue Code has a strict definition of who's considered a disqualified person. Under 4975 of the Internal Revenue Code, you'll find you are a disqualified person to your IRA, your spouse is a disqualified person, your children and grandchildren, your parents or grandparents, and there could also be companies or entities that you control or have a certain ownership interest of that are also considered disqualified persons. So for example, you couldn't hire your son to mow the lawn. Your contractor couldn't be your father. That would be considered a prohibited transaction because a disqualified person is providing a service to your IRA. If you're looking to do what Susan did or take the next step on your own real estate journey, you can check out our Real Estate Investing Hub. Within this hub, you'll find real estate guides, information regarding the Real Estate Checkbook IRA LLC, and partnering lending options, along with market reports, landlord insurance resources, and even help with 990T filing and UBIT planning. There's also direct access to investor case studies, real estate education courses, podcasts, and even connections to communities like Bigger Pockets and Passive Pockets. So whether you need help structuring a rental, evaluating a market, or preparing for your next closing, the Real Estate Hub is going to bring all of this together for you in one place. So down in the description section, you'll find a link. Go ahead and check it out. Thanks for watching. If you enjoyed this video, don't forget to hit the subscribe button right here so you never miss out on new content. And if you're ready to dive deeper, check out our other videos and resources right here.